Hi, everybody. Welcome to episode 4. Thank you for joining. Appreciate you subscribing and telling your friends about it. Please continue to share, tell your friends about it on all social networks. Let them know about it. Tell them come join in. Any comments, any questions you have, drop below. Definitely want to get into that in future videos. Any help that anybody needs or any tips that they, want, definitely drop that below, and that way I can get into it in the next videos. But like I said, I appreciate everybody joining, appreciate everybody subscribing so far. Let's continue to do this, and let's continue to, share and trade knowledge with each other. In this episode, I definitely wanted to go over this crazy week we just had. I know everybody already knows about GameStop, a couple of other stocks that, jumped off the charts this week. And everybody wanted to dive into that. So I definitely wanted to talk about that in this episode. And then the main topic of this episode would be risk avoidance. So that's the main topic of this episode 4. I wanted to go over risk avoidance, avoiding risk, avoiding things that you don't really need to dive into if you don't need to, and how to, be available to all trades, be able to get into every single stock without having, a platform or somebody stopping you to be able to do that. So first, just to dive in, like I said on episode 4, I wanted to talk about the hot stocks this week. Like everybody knows, GameStop was major this week. It had a big explosion. I think it jumped from like $30 or $70 up to max. I think it's like $450 or $480, which is a major jump when you think about stocks, especially GameStop, a stock that typically would be failing. And I know a lot of my followers are asking, hey, what happened? How did that happen? What was it about? Pretty much, just to sum it up in a short story, a couple of people, I believe it was Wall Street Bets, on Reddit, and a couple of other, big people that have following, decided, they figured out that big hedge funds were shorting certain stocks, and they were shorting it by a lot. And then they figured out, hey, if everybody buy these calls options, it has no choice. They have no choice but to then buy those shares, because then the stock is going to go, right? So a whole bunch of billionaires, hedge funds are betting against the stock. They're saying it's going to drop because, fundamentals tells you, hey, GameStop, with the virus out, people really aren't going to stores. Everything is switching to online, things like that. People ordering stuff through Amazon or Walmart, everything like that online. GameStop usually will be failing, especially with some of their recent news. But they had, some restructure as far as in their organization. And then, what everybody figured out, hey, now that these billionaires are shorting it, let's all, make them buy those shares back. Because, before I talked about put options in my previous episodes, and that's pretty much betting, saying that this stock is going to drop, right? So a whole bunch of billionaires were betting that stock and other stock were going to drop around this time. If the stock doesn't drop, then now they have to buy those shares that they betted against, which means they lose billions and billions of dollars, while the retail investor, which is us, the normal people that's not, within organizations and things like that, or multimillionaires, the retail investors can then reap the profits off of it. So that's pretty much what happened with GameStop this past week and many other stocks. They just pretty much, people realize, hey, the billionaires are shorting this. Let's drive the volume up, which would drive the price up. More people are buying the shares. The price continues to go. And the more people that buy these shares at the higher prices, the stock goes up. And now the stock is no longer at the stock that the hedge funds betted against. It's not that price anymore. So that's pretty much what happened. And billionaires had to spend billions of dollars to pretty much buy those shares back. And once they did that, that's when that money was funneled down to the retail investors that bought those call options. So that was one of the things that happened. It was many other stocks. I believe Nokia, Express was one of them. It was a ton of American Airlines. It was a ton of stocks that pretty much you would think fundamentally, you would think, hey, these stocks are going to fail. You use American Airlines, for example. With the virus out now, most people aren't flying. There's restrictions on flying. So a lot of airlines are now losing money and losing business, and you see their stock price, taking a dive, especially, when it happened in March, when most stocks did drop in March of last year. You see them continue to, be down. Well, hedge funds and, smart stock people that was out there already, had a heads up on this. So they betted against it and said that this stock was going to drop. But then when you have millions of people now buying this stock, which typically wouldn't happen because who's going to buy a stock into a failing company, right? That's what the fundamentals tell you not to do, right? You look ahead. Remember my previous episodes, I said, hey, try to think about the future. So you're thinking of the future of American Airlines or any other airline for that nature. With this virus out there, a lot of people aren't going to fly. So 6, 7, 8 months from now, you think, okay, I don't really see them, really getting a big volume of people flying. I don't see restrictions, easing up in the next 6 months just because, you got to think a lot of people aren't going to be vaccinated that fast. So with that not happening, you would typically think, okay, this stock is going to drop. So you bet against it. And that's what billionaires, they did a while back. They betted against it. And now that people are realizing and people are sharing knowledge with each other, showing, hey, this is what people are doing. This is what the big hedge funds are betting against. So all you have to do is drive volume to it and the stock goes up. And now billionaires lose and have no choice but to buy those shares now because they betted against it. So that's one of the things that you look at when you're buying options. It's pretty much what you're saying is, hey, I have the right. When you buy one contract and it's 100 shares in that one contract, what you're saying is I have the right to buy this stock and 100 shares at this price. So if your strike price or your price is at $8, the stock is at now $30. You're saying I have the right to buy that stock, 100 of them with one contract at $8. So now obviously you reap the profits between 8 and 30 if the stock was at 30. So that's what a lot of people are doing over this weekend. For me, my personal opinion, like I said, the topic was risk avoidance. I try to avoid stocks like that because that's not something that I really want to dabble in. I really don't care to follow a hype because, as you can see, if you really looked at it and looked, especially GameStop, you looked at GameStop, it's very volatile. And stocks like that, I mean, they're good. They're good to get into when you know certain things ahead of time. But if you really don't know what you're doing, if you really don't know, what's the trend or where the trend of the chart is going, I would advise you to avoid those type stocks. Yeah, you might get lucky. You might dive in there. You might get it when it's going up, and then you're happy and you pull out, you make your money. That's fine. Don't get me wrong. By all means, do that as much as you can. But I don't want people that are listening to me to say to go and buy or invest 70% of their portfolio in something that is a very volatile stock. One, because the stock is volatile. It can go up and down at any time. Two, it's very hard to determine when it's going up and when it's going down, unless you're like an insider, unless you know certain things, which the common person doesn't know. You just know what you're researching. So I would say, definitely shy away from those if you can. If you want to dive into it, by all means do it, but don't do 50, 75% of your portfolio. Do more about 5 or 10%, max 10%. Of your portfolio and see what happens. But that way you're not as hurt because when it goes down, you're not losing that much. You still have money left over in your portfolio. Invest in other stocks. Invest in stocks that have a good potential, is not as volatile. So definitely think about that. That's what my personal opinion is on those type of stocks. Me personally, I definitely did get some stocks. Definitely did get a couple of shares of some of those stocks. But at the same time, I didn't go out and invest 50 or 40% of my portfolio. It was more about, really for me, it was between 5 to 10% of my portfolio. And if I made decent money, fine. But I wasn't going to be mad if I made money and I didn't invest the other 90% because I understood there's a chance that stock can drop. And just like I was saying with GameStop, as you can see if you was following it, GameStop jumped up to $400 and then it dropped back down to around $200. Then it averaged back up to $300. So, when I talked about in preview, I believe it's episode 2, I really talked about panic money. And that's one of those things, when you see a lot of people can't handle, especially when you're a new trader, you don't want to invest, 90% of your portfolio in this GameStop. It went up to 400, you're happy, and then boom, overnight it dropped down to $200 or $100. Now you done lost a lot of money. So that's something that a lot of people can't handle and they can't go for that ride. So I would say avoid that as much as you can because that's not something that you really want to dabble in, especially if you don't really, you're new to investing, you don't really understand what can happen, and you don't understand that, hey, this stock can drop and you can see yourself going from having $500 in total of your investment down to $100 just overnight because the stock dropped down because it's volatile. And that's why I always tell people, like I said, to avoid that. That's one of the risk avoidance I wanted to speak on in this episode because I heard a lot of people, it's definitely a lot of chatter going on around, those stocks, GameStop, Nokia, Express, American Airlines, And then this week, there's going to be a lot of other talk. Duke Energy is another one that they're talking about, that was very shorted, that people are looking to invest in, and looking to pretty much do what they did with GameStop, but it won't be as big of a ripple. And what I would say was, if you look at Nokia, right? Nokia, for instance, Nokia didn't have that big of a ripple that GameStop had. And it's bound to happen like that. So if you're investing in these stocks and you're trying to follow these trends, you really don't know what you're doing, you can see yourself losing money versus gaining money. And then you see a lot of other people gaining money because they actually know what they're doing. They have some inside knowledge. So that's what I wanted to talk about a lot, getting on GameStop in this episode, and getting on those type of stocks that really don't follow the fundamentals. I will always advise everybody to stick to the fundamentals. One of the people that I like to watch, Warren Buffett, he's one of the main ones that always say stick to your fundamentals. So that's one of the things that I like to dive into. I like to stay focused on that. Yes, like I said before, you can invest a small percentage of your portfolio in those things, but don't go all out trying to try to become a millionaire overnight, and then you lose all your money. You get what I'm saying? That's something that you definitely want to avoid, and stay away from, because it can happen. I'm pretty sure a lot of people overnight lost a lot of money, just by investing in stocks, investing in GameStop. Saw it go up to $400. They're investing, and then boom, it dropped down to $200. Now they're sad. They lost all their money. They lost a lot of their money, and now they're selling for whatever they have left. And then the next day, GameStop jumps back up to 300, and now they're like, "Oh man, I should have waited." So that's why I say avoid those type of stocks, just because you really don't know what you're doing. You really can't time those type of stocks. And what I always talk about, what you'll see throughout my channel, time. Time is a major thing, because it's a major thing in the market. You have to really hone down and focus on time. Timing is everything. Timing in investing, timing when getting out of an investment, timing when getting into an investment. That's all things that you have to focus on when you're investing and when you're doing stock trading. That's just 101. So I would say everybody should focus on and try to hone down on and get their skills good up is timing. Because and patience involves in timing, right? Because the patient man always wins, especially in the stock market. The patient you are, the more patient you are, the more you'll see yourself gaining money. Try to invest into a stock that you believe in when it's at its bottom, right? Sit on it for a year, be patient, and see how much you have at the end of the year. That's what I mean by being patient. Start looking at stock as an investment versus as a quick bang for your buck. And that's when you start seeing things change for you as far as your portfolio. You start seeing it double and go up month after month or week after week, because you're thinking long term. And then something can happen in between then. It's like, wow, stock is up, made a lot of money. And that's when timing can kick in. You start thinking about, okay, timing. Stock is at its peak right now. Maybe I should try to sell at least 80% of this stock that I own in this stock, 80% of the stocks that I own in it. And that way I still have 20% left of stock. It might jump up some, I can make a little bit more. But if it drops down, at least I took 80% of my profits out, and I'm only losing 20% of my profit. So that's one of the things that I tell people to focus on when they're investing. Be smart and avoid risk. And that's another risk avoidance. And that's another thing that I want to focus on is look when you're making your money and you're at your profits. Don't take all of it out. If you want to, by all means, take all of it out. You made your money, it's at its peak, take all your money out. But if you're one of those people like me that, you kind of have that gut feeling like, hey, this stock might jump just a little bit more, then how about take out 90%, only leave 10% in? That way, risk avoidance kicks in, and if it drops down, you only lost 10%. And if it goes up, then you deep down have to be happy with, hey, at least I kept some in and I made some more money versus taking it all out. You get what I'm saying? So that's one of the things that I tell people that, listen to me, to focus on. Definitely focus on being a smart investor versus following trends and following things like that. Because if you are following trends, like I said, yes, you can make money. But if you plan on doing investing for a while versus doing investing for a month or two, you'll start to see that you'll lose money more than you make money by following certain trends. Definitely focus on your fundamentals. Focus on the stock that you believe that you did your research on, and you see, okay, 6 to 12 months down the line, this stock is going to be where I want it to be. Those are the stocks you want to dive into and start buying shares outright. And then maybe you can even buy some call options if you believe it's going to go up in 6 months to a year. Start looking at some of those call options or call contracts out there, out 6 months to a year versus looking at something that's a month out or 2 months out. Start looking into that, seeing if you can afford those, because I mean, if you can go into it, yes, they're going to be more expensive, but those are the ones that have the less risk involved in them. So what I always go with is the one that has less risk involved in it. I'm going to pay a little bit more for it, but I have less risk involved in it. And that's the whole thing that you focus on when you're investing in stocks, is risk avoidance. So that's one of the things that I want to, you all to harp on and focus on when you're doing this stock trading. Try to avoid all the risk that you can. Another thing that I want to talk on, and it's probably going to be my main point here on risk avoidance, is to how to avoid risk when you're talking about platforms. So as GameStop jumped, a lot of platforms took GameStop off. And a lot of people say, I see a lot of chatter, whether it's true or not, that, hey, they decide to do this for certain reasons because they have ties to certain companies and certain hedge funds that are now losing money, right? Those hedge funds are losing money now. So now they're going to go tell these, these stock or these, I should say, investment companies, hey, don't sell the stock anymore because we don't want to lose any more money. And since they have ties to them, they listen. Now, I don't know whether that's true or not. That's something that people are saying out there. I haven't seen anything of that. I haven't heard any, I don't see any evidence of that. But to avoid risk, just in case that is true, because like I said, we don't know whether it's true or not. And 9 times out of 10, you're not going to find out whether it's true or not because you're not that high up. To avoid risks like that, have multiple platforms. Have your money spread it out. So just like you're diverse in stocks, be diverse in the platforms that you use to invest in stocks. And what I mean by that is, don't just have a Robinhood or don't just have a Webull. Have a Robinhood, have a Webull account, have a TD Ameritrade account, have a Fidelity account, have multiple accounts. That way, when one company such as Robinhood says, okay, you no longer could buy this, or you no longer buy 2,000 shares of GameStop because we got a feeling that something's happening, you have other companies that still allow you to buy that, and you can go and put your money in those companies. And I'm pretty sure as live as you can see, you have those Reddit users saying, hey, ban Robinhood, get away from Robinhood. I personally wouldn't say ban Robinhood. I would say be diverse in your investment, and be diverse in the companies that you put your money in. Because when you're diverse in that, you really don't have too much to worry about. When Robinhood decided to stop doing the GameStop and stop allowing people to buy, me for myself, I said, okay, I understand that, but I'm going to go to my other account. I'm going to go to my, maybe TD America or Webull or Fidelity, and I'm going to go invest in GameStop there since they're still allowing me to do it, and now I'm not losing money. That falls into risk avoidance. That's one of the things that you have to have, and I want everybody to focus on that on this episode, on episode 4. Focus on risk avoidance wherever you can. Avoid risk. If you can look at something and you can see there's something that you can cut back on, or you can, it's another way you can get around it, avoid it and do it. Think of all outcomes. Just like with this GameStop thing, I'm pretty sure a lot of people only have Robinhood accounts and they didn't think of the outcome of Robinhood stopping that. You have to think of that, because that's one of the things that you have to do. Just like you're thinking about that in stocks, whether the stock's going to go down or up, you have to think about, is this platform going to allow me to trade this stock? Or do they have any ties to any hedge funds that may be affected by this if, million people decide to, now buy this share and raise the stock price? So that's one of the things that I wanted to focus on. Like I said, risk avoidance, it's major. You have to focus on that. You have to really hone yourself on that, and stay away from anything that can hurt your portfolio. That is the major thing that you have to focus on. Avoid every risk possible and you'll be okay. And think long term versus thinking short term. Don't follow trends. It might be good. If you want to follow a trend, that's fine. You can do that. You can step your feet into it, but do it with a small percentage of your portfolio. Don't do it with all you have is $500, then go and invest maybe, $50 or $100 of your money into that. Don't go and invest the whole $500 and now it starts dropping and now you've lost all your money. It's pointless. There's no point for you to do that. Don't look at it as I'm trying to become a millionaire overnight. Look at it as I'm trying to become a millionaire over a year or over 2 years or even over 3 years. That way, possibly you become a millionaire before then, but if it doesn't happen, you still have a game plan. You're not losing money. And you're not constantly seeing yourself take loss after loss after loss, because it's very, investments, like I spoke about in my past episodes, is a mental game. And if you're constantly losing, then now you're not really focused and you're not really, looking at this stock as good as you should be. And now you're going to invest in something again and lose more money. And losing is not fun. I'm pretty sure a lot of people have lost in the stock market, and they can be a witness to this. It is not fun to lose money. It definitely plays with your mental, especially when you're going forward and when you're looking at other stocks. It definitely, it gives you a little blurred vision at looking at these stocks because you're losing money and you're trying to recoup money. And one of the major things I want to speak on before this episode ends, if you lose money, that's fine. Don't ever try to chase it back. Try to look at another investment to make some money, but don't ever try to make money back. If you lost 500, don't try to go invest something because you think it's going to make you 500 overnight. Because that's when you start losing money and it starts adding up and adding up and adding up. But that's one of the things I wanted to focus on. Like I said, GameStop was a wild week. All those hot stocks was super wild this week. I'm pretty sure a lot of people became millionaires overnight. I heard one person turned like 700,000 to 50 million. So that was major for a lot of people. I'm pretty sure pretty life changing. But I don't want that to blur your vision on the long term because yes, some people made money, but that's not how it always happens. Just like when you buy a call contract, yeah, you might make 3,000-4,000, but then you go and buy another call contract and you lose the whole 100, 200, whatever you invest into it. It's not always like that. So it's better to stick to your fundamentals. That way you see yourself constantly rising versus declining. Instead of having one of those charts that's just you go up and you go down, you go up, you go down, kind of like the GameStop chart this past week going up and down. You don't want your portfolio to look like that. You want it to be a constant, mountain climb to the top and then continue to rise because that's where your biggest bang for your buck is. And for me, that's one of the things that I learned from watching, the greatest investor ever is Warren Buffett. He's very patient. He thinks very long term. He doesn't think a year or two out. He thinks far out. And when you look at it, it all becomes to fruition for him because he's thinking long term versus short term. Yeah, he might lose some money this year. He might lose $1 billion this year, but then next year he's going to make 2, 3, 4, 5 billion because he sat on it and he thought long term versus short term. So focus on that. Be diverse. Have a lot of risk avoidance. Look where you can avoid risk at in your portfolio. And if you can, go and do it because I'm telling you, it will save you in the long term. And one of the other things, like I said, is focus on being diverse in the platforms that you decide to invest in. If you have only a Robinhood, start looking into a Webull. If you have Webull and Robinhood, start looking into adding Fidelity and add some money into that. That way, when one account is down, when one account is up, you start evening out and you look at, okay, I lost 500 in my Webull, but I just gained 1,000 in my Robinhood, and I gained another 2,000 in my Fidelity. You see, when you look at it like that, and now you're being super diverse, it all adds up and it helps you lose money less. Because you're going to lose money, but you don't want to lose a lot of money at one time because it messes with your mental. So then spread it out, be diverse in everything that you do when it comes to stocks, and you'll see yourself gaining a lot of money. I appreciate everybody joining this episode. Continue to share, continue to subscribe, continue to tell your friends about it. Like I said, definitely want to grow. Drop a comment below. Anything that I can help you with, anything that I can do better in my episodes, drop a comment below. Leave your advice, leave everything. I appreciate it all. And thank you all for joining episode 4. Thank you and have a great day.